Hello and welcome into the KE Report. I'm your host, Shad Markowitz, and I'm speaking today with Jordan Roy-Byrne, founder and editor of TheDailyGold. There will be a link for TheDailyGold down below this interview. Definitely check it out if you like Jordan's work. Jordan, it's always great getting you on the show just to get your thoughts on the macro setup in the markets and in specific on the precious metal sector that we all follow so closely. I guess let's maybe start things off today with there's a lot of investors that are worried about the weakness we've seen in the precious metals, gold, silver, the mining stocks. They've all been under pressure, but gold is usually the prime mover. So let's start there. A lot of technicians are concerned about that 1675 level of support. They're worried that if it breaches there, we've got real problems. It'd be making a new lower low. It would break that higher low. And you had mentioned off mic that 1675 level is of less significance to you. You think that people have made a big to-do about it, but you actually are more concerned about the breakdown in the trend line you saw. And this was a real trend line that had multiple touches along it. So maybe just discuss why you're not as concerned about 1675 breaking, where you see support coming in, and how you're looking at things technically.
Well, I think breaking below 1675, it's not insignificant. So I don't want to say it's not significant, but when you're looking at, daily, weekly, and monthly charts, especially when you look at even on a daily chart, you look at the closing level, gold has only rebounded from 1675 one time. So I know intraday, I think it got down there in the middle of last year, but when you're looking at long-term charts and you're looking at daily or weekly closing prices, you can see the market has only come down to that level, traded down there, and rebounded off of it one time. So the more significant line for me is if you connect the low in early 2021 or spring 2021, you connect that with the other lows up until recently the May low, and you can see you have a trend line there that's been touched 6 or almost 7 different times. So that's another thing when you're drawing lines on charts, you really want to draw them, or you want to try and connect as many points as possible. If a market hasn't connected 3 or 4 times, then it's really not worth it to draw the trend line. So in this case, it's really clear that there's a trend line there, and we can see that since gold broke that trend line in June, it has been diving in the last 3 weeks or so. So you saw a sharp decline when gold broke that trend line. And this is similar to what happened in 2017 and 2018. You could draw a trend line there connecting, 4 or 5 different points. And so gold broke that trend line in June of 2018, eventually bottomed in August of 2018, really didn't get going in earnest until December, which was the Fed's last hike at that point in time. But when gold broke that trend line in 2017, 2018, I looked at it and there was a measured downside target of about 1180, which is exactly where gold came down and bottomed. And so this time, if you're looking at the break of this trend line, the measured downside target comes down to about 1600. I mean, depending on how you measure it, might be a little bit higher. So that to me is the real significant line. And when we're looking at sentiment and positioning, we know that sentiment indicators are, in some respects, they're at extremes. In some respects, they're pretty close. Looking at the COT, the net spec positions in gold are still a little too high for me. So there is some more room for speculators to sell and for that position to come down even more. Looking at the pure sentiment indicators, which are tracking, percent bulls, those are already near extremes. So looking at sentiment, so if we were to see gold, dive to 1600 in the next month or two, that's going to clear out even more people and you'll see sentiment at a real extreme. And so I'm not worried that, losing 1675, again, it is significant, but I'm not worried that it's some massive technical breakdown because that's kind of the default thinking of everyone is, oh God, that's it. This is 2013 again. When gold has only rebounded from that level once, and if you look at the break of the trend line here, that's really what's driving the current decline and what can drive it down to 1600 potentially. But on the other hand, it all comes back to how does the Fed respond to this recession? When are they going to pivot? When are they going to ease policy? And how significant are we going to see fiscal at the same time? So those things are going to really drive the market. And so, I'm not that concerned if we see gold continue this breakdown and trade down to that level because we're on the cusp of, not this week or next week, but I believe in the next couple of months, we're on the cusp of a shift in Fed policy, and that's going to be very bullish for precious metals. And at the same time, again, you see this, you see a move down to 1600. Sentiment indicators are going to be at true extremes at that point. And I know that people reference 2013, but gold had gone up for 12 years in a row. It was up sixfold in that period. So it's a completely different situation than what's going on right now. So I'm not saying this decline would be insignificant. It certainly would be painful, but this is one potential way that things could shake out here, where you see more of a decline, you see sentiment really get extreme, but at the same time, that brings you very close to the Fed shifting policy, which can give you a real major rebound.
Well, yeah, I know a lot of people are waiting for that Powell pause or the Powell pivot, where they will see eventually the Fed admit that they can't go much further with their rate hikes, and that should be bullish for the sector as a general rule of thumb. There are people, though, Jordan, that are concerned that gold may have double topped when you look at the August 2020 high above 2000. I think it was 2089, and then the March of this year, it got up to 2078. Is it possible that if gold was to keep piercing these lower levels and keep breaking through support levels, that it could have double topped, or is that not a concern that you share?
Well, I think it probably has double topped, but that tells you that, that's more reason that you're probably going to see gold move below 1675 convincingly. But the thing about technicals is, technicals are a context. They're really not a catalyst. And so again, this comes back to, tell me what the Fed is going to do. Tell me how this recession is going to be. The double top. It's really a reflection of the market thinks that we're not going to see any real meaningful pivot from the Fed. Maybe they'll stop hiking rates for a little while. Maybe they'll do a rate cut or two eventually, and we're only going to have a mild recession. And so that's what I think what's being reflected by the double top. But if we get into a situation where we're in a real recession and the Fed is forced to ease policy and we need some fiscal next year on top of that, that kind of response is going to, push gold right back up and gold to that major breakout. So it all comes back to the fundamental response and the fundamental developments. We have to remember that that's what drives markets. Technicals are a context and not a catalyst. Yes, it does look like a double top, but that doesn't preclude gold from rebounding and testing that level again. Because you can look at, if you look at the gold chart in September, October, November of 2008, if you look at a monthly chart, it's really, really ugly. And I would have told you it's going to take gold at least 12 months to get back up and, break above this 900 resistance. Well, it happened in only 7 months. So, I'm not downplaying the significance of the double top. It is significant, but I'm more concerned with what are the macro developments that are coming and what is the Fed's policy response going to be? Because the market, based on the double top and how things are trading, the market thinks that the Fed is going to be, tight for longer than we think, and that the recession is just going to be mild and the Fed is going to be able to be tight for the most part through the majority of the recession. I think that's what's being reflected by the gold chart right now.
Well, Jordan, one other point of contention people have, and there's some in both camps, is that when we do finally see the Fed pivot and eventually switch back to cutting rates, which they'll be forced to ease and inject liquidity in the marketplace and lower the rates to give the market a boost, a lot of people think that will just be the green light to jump into everything, and that the everything bubble will take back off, and that the general stocks will start racing higher, and that this will really throw a wet blanket over the idea of the precious metal sector diverging from the general markets, which is what we generally want to see in a strong uptrend. So what would you say to those people that think it's just going to be an everything bubble as soon as the Fed pauses?
No, I completely disagree with that. That's a real dangerous thinking, in my opinion. We know that in this kind of setup and historically that the Fed easing policy, that's when you want to own precious metals. That's when they outperform the most. And I looked at some of the, 4 of the 6 or so most significant bear markets, since 1929. And in 3 of the cases, the Fed eased policy about a year after the bear market began. And, in all those cases, it still took several months for the stock market to bottom and for the economy to turn around. So the Fed being forced to ease, part of that reason is because, the economy's in a recession and it's necessary. They've done enough tightening to hurt the economy. And so it's necessary that they have to reverse that. And so, yes, that's good for the market. But if the economy is not aligned, it's not immediately bullish. I mean, you could see a rally, but it's not super bullish for the economy until the recession is near its end, basically, and the stock market has been bombed out. And so, my thinking is that we're seeing, a bear market rally right now, but for them to ease policy over the coming months, you need the stock market to go to lower lows and to break down. And so that isn't going to be reversed immediately because the Fed eases policy. And I would throw some commodities in there at the same time, because if you're in a recession and the Fed, after wanting to be tight, is forced to ease, I mean, that's not necessarily, again, you could get a rally, but it's not necessarily immediately bullish for copper, energy, or all those things, in the stock market as well. I mean, so I would, the Fed being forced to ease, first and foremost, that's most bullish for precious metals. Commodities ex precious metals, in my opinion, are not going to be a buy until you get later in this bear market and recession, and the downside is pretty low, and it looks like, we'll be recovering soon economically.
That makes sense. Appreciate you sharing your thoughts on it, Jordan. And yeah, we just hear a lot of people think that it's just going to be a boost to everything, but in a recessionary backdrop, that may not be the case at all. It may be just the reverse, and we may finally start seeing that divergence of the precious metals over other commodities and over the general markets, which really makes it more of a true bull market. But let's shift over to the mining stocks. I know there's always support levels you're looking at in GDX and GDXJ, but first I just want to ask you, Jordan, sometimes at the top, we'll see the miners roll over first and kind of lead the metals down. And sometimes at bottoms, they'll sniff it out first. And you'll start seeing at least some of the majors and mid tiers and royalty companies bounce first, kind of as an early warning sign. But ultimately, the prime mover is the metal. So in this particular case, could we see, from such oversold levels where they're at now, a bounce in the mining stocks, maybe just a relief rally or a bounce or something like that, even if the metals continue to pull back? Or is it ultimately going to be the metals that need to lead the miners higher?
Well, I think here in the short term, it's interesting because you're seeing a bear market rally and the S&P take hold. And so the miners are doing a little bit better, but they're still mostly, the last 3 days, gold has yawned at the dollar decline. And for the most part, the miners have kind of yawned. They have rebounded, but not quite as much as you would think. I mean, it's a really interesting question because they're so bombed out now. I mean, we obviously, looking at GDX and GDXJ, I know that GDXJ, I know there's really strong support at 26 or 27. Similarly for GDX, I know it has strong support about 10% or so below where it is. So, if we do see 1600 gold, my guess would be you probably see the miners tag those levels. But, I mean, here and now, they're already so extremely oversold. GDXJ is as oversold as it has been in the last 7-8 years. The large caps are not quite that oversold, but they're pretty close. So, I mean, I still think it's a buying opportunity in this sector. And, if we do see gold, trade below 1675, I mean, that's when you want to be a really aggressive buyer of this sector, because everything is going to be really close to aligning fundamentally, the technicals and sentiment. But it will be interesting to watch and see if the miners can diverge a little bit around the bottom and just see if, because they're so bombed out, maybe there's not enough selling pressure to drive them that much lower. But bigger picture, I mean, the miners obviously do need the gold price to go much higher. So I don't know if they're going to lead the coming rebound, or if it's more a function of they're so oversold that there's not enough sellers left to drive them that much lower during the potential period of gold, going below 1675 and going to 1600.
Yeah, that's kind of where I was going to lead with the next question, Jordan, is most of the pain already priced in? Because if you look at where some of these mining stocks are valued compared to where they were when we were at these same price levels before, they're far under where they were back in 2018 through 2020, and they're far lower than where they were, some of them back in 2016 at a lower gold price. They're almost priced like gold is at 1450 already, and it's not. It's still at 1700. So my question was more, have we seen most of the pain in the mining stocks at this point? Did they kind of forecast that we were going to see these pull back in metals? And if gold does dive down further, could that maybe prevent them from pulling back quite as much? Is that the way you're looking at it?
Yeah, I mean, possibly. I'm looking at it that I think there's more risk in the more liquid, large cap names because they're not quite as bombed out as the juniors. And so I think you've seen most of the damage in the juniors. GDXJ, I guess, is bigger juniors. I do think GDXJ, could test that 26, 27 level. But for individual stocks, there's a lot that I follow. I mean, there's some where the charts are fishing lines are completely bombed out. I don't know how much more selling you're going to see in those stocks versus if you're looking at, there's a few here and there that, maybe they've been holding up okay, but they're starting to crack. Those types of charts could see more selling. So you have to look at things on a case by case basis. But I do think, remember why these things have been so bombed out is because costs have increased quite a bit. And now you're looking at the gold price is not even 2000, 1900 anymore. It's 1700. So if you see the gold price trading in the 16s, I mean, the margins for these companies they're just compressed significantly compared to 24 months ago. So that's why they've come off so much and they're trading at these levels. I mean, that's really troubling. But at the same time, if we start a real bull market, when the Fed eases policy, you're going to see gold at worst rally back and retest its high. You can see a really, really good move in the sector, even with that. And, then again, if you're starting a real bull market, that's when you can get 5, 7, 10 baggers and even more. So in any event, we're coming up on a point over the next, month, 2, 3 months where it looks like we're going to be seeing a really significant turn in precious metals. And for the rest of commodities, it's going to take longer.
Well, just one last question to wrap us up, Jordan, and that is we've heard a lot about the longer term pattern that looked like a very bullish setup, which was the cup and handle pattern. And a lot of people have said that pattern has now broken down. Which camp are you in? Are we still in that longer term cup and handle pattern that's taken about 11 years to play out, or has this recent weakness broken that pattern?
Well, again, this is coming back to technicals are a context. They're not a catalyst. So, it could be broken from the standpoint of, well, it doesn't look like gold is going to, break out in the next couple months. But, and I will say, I would prefer that gold hold above 1675. Then you'd have a really bullish consolidation where sooner rather than later, gold would be more likely to break out. But at the same time, gold trading down to 1600. If you have a really deep recession, you get a huge policy response. Gold's going to rally back and, it'd probably break out in that scenario. So with respect to the pattern being broken, it's not broken. And the pattern is just telling you that if gold breaks above 2100, there's a setup where it can go vertical to 3,000, 4,000. That's the key with the pattern. But it's not telling you that gold is going to break out this month or the next month or next year. You have to use other forms of analysis to measure that. So the pattern in the setup is not broken. It's still there and it's going to be there regardless of whether gold breaks out in the next 3, 6, 9 months or 12 months, or if it takes another year or two. The pattern is still going to be there. It's still going to be explosive.
Okay, well, we'll wrap it up there. That gives people at least something to hang their hat on, that it really isn't as important as the macro drivers that are going to drive gold back up to the all-time high. And when it crosses that Rubicon and breaks above 2100, let's say, it's still going to have a strong leg no matter what the pattern says. And it's really the macro drivers that are going to push it up there. So we'll keep our eyes on what the Fed does. We'll keep our eyes on this rate hiking cycle. We'll know more next week. Jordan, it's always great to get you on the show just to share your thoughts with us, the technical levels you're watching, and just the macro fundamental drivers you're watching. So if people like Jordan's thoughts, definitely click on the link below, and we'll talk to you again next week.